Now, as a lot of you guys probably already know, I'm a huge fan of dividend growth style ETFs like SCHD, DGRO, or VYM, because over time ETFs like those have not only paid dividends consistently quarter after quarter, but the dividends have went up over the years, offering investors more and more cash flow as time goes on. Now, even though I love dividend growth style ETFs, I also like higher yielding ETFs, names like JEPQ, like JEPI, QYLD, and others that might not grow as much or have as much dividend growth, but offers say 8, 10, 12% yield right off the bat. So in my portfolio, you're going to find a mix of different dividend growth ETFs and stocks for that matter, but also different high yielding options that are going to offer a boatload of income from day one. Now that brings me into today's video where we are going to go through an ETF I've never talked about on this channel. An ETF that offers dividend growth exposure, but also through the use of options is offering a 10% yield with consistent payouts and no NAV decay. So for this video, whether you're a dividend growth style investor or whether you're a high yield investor, or maybe like myself, a little bit of a hybrid, make sure to stick around, drop a like down below, and let's get right into it. My A to Z dividend investing ebook has helped countless dividend investors get started with their journey. And my custom dividend tracker that I'm constantly using here on the channel has also helped so many investors stay on track and allow them to see their dividend income in real time. Well, today I have another treat for you guys. I'm not only going to offer you my A to Z dividend investing ebook and the custom dividend tracker, but also just for a short limited time, I'm going to be adding in my brand new weekly dividend blueprint ebook to show you how you can get started with weekly dividend ETFs and add this into your investing strategy. This offer is not going to last long, so go ahead and click the first link down below in my description, and you're going to get both ebooks and the custom dividend tracker bundle. But like I said, please act fast because this won't be around for long. Now let's get back into the video. So the ETF that we're talking about in today's video is going to be the Amplified COWs or CWOS covered call ETF or HCOW. Now, Amplified ETFs is the creator of Devo, one of my personal favorite income-oriented ETFs that offers around 12% per year since inception. Amplified ETFs does have some pretty good products. Now, just as I recently came across this ETF, I briefly looked into it and thought it was definitely interesting enough to make a video on. Now, first off, this ETF has only been trading since September of 2023, so it hasn't been around all that long, but so far I'm liking what I'm seeing. It says 3 reasons to own HCOW. Number 1, focus on dividend income plus high option premiums, a portfolio of dividend paying high FCF companies that have historically grown dividends plus a covered call strategy that aims to generate approximately 10% or greater annualized income from option premiums. Now, in my long-term portfolio, I buy into tons of different dividend names, and a portion of my portfolio, I actually utilize covered calls, and actually on my own sell call options to earn a ton of premium and help with downside protection. I absolutely love selling covered calls. So far this ETF basically seems to be doing already what I'm doing in my portfolio, but let's read on. It says number 2, don't be short-sighted, look beyond the rearview mirror, access both trailing and forward free cash flow metrics to help ensure a balanced evaluation of financial health and growth prospects. Now I'm going to share with you what holdings are inside this portfolio in a second here, which are kind of interesting. Now lastly, it says professionally manage access a professional managed dividend and option income investment strategy through the efficiency of an ETF. Now the total expense ratio for this one is 0.65%, so not the most expensive expense ratio we've ever seen, but for an ETF like this one, it's a little bit on the pricey side. It says objective and strategy, HCOW is actively managed strategy driven ETF that seeks to provide current income through a portfolio of dividend paying companies with characteristics of high cash flow, yield combined with a covered call strategy. Now they also included, sort of broke down some of the terminology. FCF is the remaining cash a company has after covering all expenses. High FCF is one way to indicate the financial stability of a company. Trailing FCF measures a company's remaining cash over a past period of time. And future FCF estimates a company's future cash flow and ability to be profitable. So any ETF that sort of uses multiple screenings, obviously kind of like SCHD does for their underlying holding, is honestly respected in my eyes, especially if they're chasing after metrics like these ones. Now the size of HCOW is around 10 million plus in net assets, so it's still a relatively small fund, and it probably is going to attract more of a niche investor. Now this is one of the things that really got my attention. The distribution rate is 10% plus, which is of course important for me specifically because I'm still trying to add as much cash flow to my long-term portfolio. My goal this year is $8,500 per month in dividends on average. So with a 10% yield, that's definitely going to help me get there a lot faster. Now an ETF is only as good as its underlying holdings, so some of the largest holdings, some of the largest exposure is in names like Tapestry, like Syncora, Genpact, Cisco Systems, Schlumberger, Timken. I mean, I really don't recognize a lot of these different companies. I recognize, of course, some of them like FedEx, like Comcast, but to be completely honest, some of the names on this list are names that I haven't really dug into all that deep yet. Now, along with all the holdings you can see right here, they sell calls and individual names. There's actually a ton of options being sold right now, which makes me feel a lot better about that 0.65% total expense ratio because the management is getting put to work managing all these covered calls. Now, regardless, like I always say, an ETF is only going to be as good as its underlying holdings, so I would have to look a little bit deeper into this one and see if I do want to gain exposure to these names. But honestly, for the most part, they seem pretty tried and true, and again, if they made it through the screenings, I guess they're probably decent, right? Now, so far, I like the objective and strategy behind HCOW, the Amplify Cows covered call ETF. But looking at this ETF in the max time frame, it started trading again back in September of 2023. And as you can see, as of right now, it's basically flat in the max time frame. Just as of recently, it was up a little bit, but with the rest of the market still in decline as of right now, HCOW is basically back to where it started trading, which of course would be a massive disappointment unless of course HCOW pays around 10% yield per year, which is what it's been doing. Now, just speaking for myself, if I'm earning, say, 9%, 11%, 15% in income per year, I really don't care if my investment underlying trades flat. I know some of you guys might think that's crazy, but if names like SPYI, names like HCOW even, if those names trade flat over time and pay me 10, 11%, 12% yield, I'm fine with that. Now, HCOW on the max time frame is paid out around 17 cents more or less per share per month, it looks like, with some months being a little bit higher, the most recent being the highest payout of 21 cents. Now, this means that even if you bought this ETF during inception, you haven't really made much money off the price return. If anything, you lost a tad. But if you bought during inception, you returned around 17 cents per share per month for every single share that you had, especially for an ETF that costs around 20 bucks or so. Not bad whatsoever. Now, lastly, I want to sort of talk about if or if not I personally am planning on adding any HCOW to my portfolio, because as of right now, I do not have a single share of this one whatsoever. Now, of course, I already hold on to Devo and QDVO, which do yield a little bit less, but have somewhat similar strategies, buying into a basket of stocks, sort of a curated basket of stocks, which I will say I like that strategy. I like the fact that it's not necessarily tracking an entire index. It's sort of based upon different screenings for this one. And then, of course, selling covered calls and individual names, which definitely gives this ETF the potential to earn, like we saw, around 10% distribution rate per year. Now, for the most part in my portfolio, I want to buy into high-yielding names that track an index, something like HCOW or even SPYI that utilize the NASDAQ and or the S&P 500, and then sell call options and generate income, etc., etc. And that's just because even though this ETF specifically has a very good strategy, in my opinion, buying into names that offer free cash flow, etc., etc., some of the names, some of the underlying inside this ETF are just not necessarily names I want exposure to. Although after doing some further research, a lot of these names are pretty low beta and are probably not really going to do all that much for the most part, which is honestly sort of what I'm looking for my portfolio. And again, if this ETF trades sideways over time and pays me 10% per year, I mean, that's not the worst thing in the world. Now, also important, looking into the tax implications of this ETF's distributions, which are very important, especially more important to some investors than others, but just the most recent 19A-1 is in connection with the monthly dividend payment of around almost 21 cents per share payable on February 28th of this year to shareholders on a record date, etc., etc. It says it is anticipated that 81% of such dividend will be return of capital or ROC, which is definitely helpful and is definitely something that I'm looking for in my portfolio. So Amplify ETFs, for the most part, from what I've seen, offer a lot of return of capital from their ETFs. I could be mistaken, but this ETF seems to be doing that, at least for the majority of the payouts. So all in all, HCOW looks like it has a good strategy objective. It seems to be tried and truly so far over the last year plus. It offers exposure to a diversified set of stocks that I really don't have much exposure to as of right now, and offers that covered call overlay, which is going to generate a ton of income. Now, along with that, the income seems to be somewhat tax efficient. So honestly, if I was looking to add another ETF into my portfolio, I'd probably add some shares of this one. Now, with all that being said, I do want to hear from you guys down below when it comes to the Amplify Cows covered call ETF. Would you or would you not add this one to your portfolio? Let me know in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.